A lot of households, we estimate around 87%, are locked in place with mortgage rates below 5%. This means that they're going to stay in their homes longer and likely remodel rather than move. But this is also an opportunity given there's just zilch existing home supply out there for builders to come in and fill that supply void.
Put that coffee down.
Creators are leaders. Be careful what kind of leaders you're producing here.
Helen, we're both in sales. Let me tell you why I suck as a salesman.
They realized that to be in power, you didn't need guns or money or even numbers. You just needed the will to do what the other guy wouldn't.
I'm not leaving. The show goes on.
Well, hello there, friend. Welcome back to the Construction Leadership Podcast. I am your host, Bradley Hartman. On this show, we connect you with leaders from across the country every single week to help you lead more effectively. This episode is brought to you by the Simple Sales Pipeline. If you have a sales team or business development managers or whatever euphemism you use to talk about the people who sell things and land new business, it's critical that we continue to forecast the future. And if you're not, you're flying blind into what we're going to hear with our friend Matt Saunders of John Burns Real Estate Consulting into some uncertainty. Is it a recession? Is it not? Nobody knows. Doesn't really matter. What does matter is we continue to land new business, ideally at higher margins. How do we make sure we can do that? By calculating and organizing your sales pipeline. The Simple Sales Pipeline was built specifically for the construction industry. Learn more at thesimpleSalesPipeline.com. Now, Mortenson, the large commercial builder out of Minneapolis, recently put out their construction cost index, and they shared a bunch of insights. One of them was that over 2022, they saw building materials products increase in prices by almost 7%, 6.7% if you want to know the actual number. However, in December of last year, they saw many of those prices reverse course, down 2.7%. So they looked at Milwaukee and Minneapolis and Seattle, Denver, Chicago, Portland, and Phoenix, and showed what was happening. Was it mild increases, or were these prices coming back down to something closer to normality? And the punchline at the end I will read is, our construction cost index indicates that the increases experienced over the last 2 years are slowing, Mortenson reported. Based on market data and our insights, we remain cautiously optimistic while looking ahead to gauge further impacts. And they closed with, we recommend customers maintain resiliency as we believe Q1 of 2023 could provide greater clarity on industry direction for the remainder of the year. You know what, Mortenson? I agree. I think we should always maintain resiliency. We should be able to take a step back, talk to our customers, talk to our prospects, talk to our suppliers. What is happening here and how can we remain resilient? What Mortenson didn't say, are there unique circumstances where you do not want to be resilient, where you want to be rigid and inflexible and be able to snap at a moment's notice? No, you don't. You always want to be resilient. So how can we do that? Well, for me, I try to think about the smartest people I know when I have areas of uncertainty. And our current state of the economy certainly falls into that category, which is why we had Mr. Matt Saunders, Senior Vice President of Building Products at John Burns Real Estate Consulting, to join the show to help illuminate some insights. I met him last October and was really impressed with his business acumen and his ability to take a lot of this data and simplify it into a intelligible narrative that made it easier for me to make decisions. And that's what leaders do. Number one rule for leaders, you must make decisions, ideally intelligent ones. So without further ado, please enjoy my conversation recorded just a few days ago with Mr. Matt Saunders, Senior VP of Building Products at John Burns Real Estate Consulting. As always, thank you for listening. Mr. Matt Saunders, welcome back to the show.
Great to see you again, Bradley.
Hey, couldn't be more excited. And I think this is really timely. You were the star, one of the stars of episode 294 of the Construction Leadership Podcast when we were together in October in San Diego at the WCLBMA's event. And your presentation there, your context, the data you provided was really helpful for me just to kind of understand what's going on in my local market with us. So I was excited to get you back here. And again, very timely because we are seeing kind of inflation remain high. Had more conversations with people about the price of eggs than I ever had in my entire lifetime. Meanwhile, unemployment rate is as low as it's been in 5 decades. Is it a hard landing? Is it a soft landing? Hell, are we even in a recession? What's happening with building materials? We have all these questions, and that's why you're here to help us. So maybe let me know if this might be an intelligent way to start. We've all kind of been through the pandemic, and on one hand, that feels like very, very fresh and recent. As I think back to like March of 2020, that feels like 10 years ago. So maybe do you want to take a step back and say, how did we get here, and maybe give us an overview before we kind of plunge ahead?
I think that's a great place to start, Bradley. So it all started with the pandemic, early 2020. And I think it started with the response, the fiscal and monetary response. There's a ton of money thrown at the economy, trillions of dollars, as well as the Fed acted very quickly to reduce the Fed funds rate effectively down to zero, as well as they resumed their purchases of debt securities, in the Fed jargon, quantitative easing. And what this really does is it serves to keep longer term rates down, hold down longer term yields. And what we saw is that mortgage rates just tumbled. And so as we all know, what is the most interest rate sensitive sector? It's housing. And because of all this money that was thrown into the economy and interest rates that just bottomed out, housing just boomed. And then you add on another layer to this, which is just a broader acceptance of work from home, allowing a relocation, often just to 1 or 2 counties over, but also to longer distance move. Boise is a poster child for this. And we just saw home values skyrocket, home equity levels surge to record levels. So that was the context before the Fed saw inflation had really run away. Maybe I'll also talk about what happened with remodeling as well before the Fed kind of like reversed course and tried to rein in all these inflationary pressures. What we saw in remodeling, we floated a survey when the pandemic first hit, and we saw a cancellation of those larger pro projects, and then almost an immediate uptick on those smaller DIY type projects. This DIY COVID bounce ended around mid-2021. And following this, all those deferred larger projects came forward. And we just had a surge of larger projects involving a pro. Homeowners, when interest rates dropped, they refied their homes, they took out cash, they put them towards remodeling. So until around mid-2022, we've had the strongest demand for building materials, both on the remodeling side as well as the new construction side. I'm sure a lot of your podcast listeners can really appreciate just this boom period we've been through. So what's really changed? Maybe I'll get into that. It's really the Fed. So the Fed stepped in. They saw inflation had really gotten ahead of themselves. As of March of 2021, they were saying that this is going to be, in their words, transitory, not very lasting. This will pass. This proved to not be the case. And the Fed, by the end of 2021, inflation was way ahead of measures of inflation, CPI, the Consumer Price Index, as well as their preferred measure, PCE. And so what the Fed did in 2022 was embark on probably one of the tightest rate tightening cycles we have in history. And so that's reversed a lot of the effects that we've had within housing, and to a lesser extent within remodeling, because remodeling is just less interest rate sensitive. And so this is really the backdrop where we've seen starts really tumble from around March of last year. And we are seeing some signs of weakness once we get through backlogs within remodeling. But remodeling is, I listened to your podcast that you did with Mark Harari. Remodeling really continues to be the prettiest girl at the dance for a number of reasons that I'd love to get into. But there's a really interesting backdrop that's playing out in 2023 for building materials spending demand based on how we got to where we are. So maybe I'll stop there.
Yeah, no, perfect. You laid the groundwork really well. A couple things there. CPI, you mentioned Consumer Price Index. I know what that is. You mentioned PCE. What is that?
So that's another measure of prices that is favored by the Fed relative to CPI. And the reason it kind of like gets into the bottom level of how these indices are constructed, but PCE also takes into account indirect purchases by consumers, not just direct purchases by consumers. And then it also accounts for substitution effects as well, better than CPI. So changes in the overall basket of goods and services that are being purchased. So for this reason, the Fed generally looks to PCE over CPI. But the bottom line is they're both well above what the Fed would like, or inflation around 2%. So inflation is really the issue of the day right now. And the Fed is ramping up. They're tightening to bring in inflation, and housing is kind of like in the crosshairs right now.
Yeah. So PCE, what do those letters stand for?
Personal Consumption Expenditure Index.
Personal consumption expenditure. Got it. Okay, cool. I have kind of a working theory. I have no idea if this is right. I have no idea of kind of the historical accuracy of this, but I have a sense from the Fed, but also certainly our builder friends and clients. And then also, I think this kind of goes to even some manufacturers of products. It feels like almost everybody is driving the vehicle with both feet. I'm jamming on the gas, but meanwhile, I've got my foot hovering over the brake pedal, and then vice versa, where I've seen builders, you mentioned Boise, I think it's a good example. We're jamming on the gas, going as hard as we can, as fast as we can, and then we turn around and we slam on the brakes immediately. And then the minute there's an opening, and we've seen this in other markets, we're slamming on the gas again with starts. Is the Fed, are they reacting more quickly in just responding to what they're seeing? Or not necessarily? And historically, whether it's, I don't know, Paul Volcker or Fed chairs in the past have also ramped up and throttled down interest rates in a very similar fashion as it's happening now.
The Fed raised the Fed funds rate by 4.25 percentage points in just 12 months. So they're saying they're data driven. I think a lot of people, including myself, would say that they got a little bit behind the curve. So they've really ramped up rates to kind of get ahead of things. They would say, and I believe them, that they're data driven. So they're going to wait until the data comes in. But I think at this point, they're really worried about inflation becoming elevated inflation expectations just becoming embedded in the economy. So they're being quite vigilant at this point.
So you've seen kind of softwood lumber prices kind of come back down and settle, but you were just kind of giving some context on some data about, yes, some of construction materials and building materials and different products have come down. Others have not. And you're kind of seeing maybe a little bit of a fork in the road here between some that are going to come down and some that seem to be resilient. Maybe can you go into a little bit there and talk to us about the 2023, building materials kind of projection is where you see things going?
Yeah, great. And I think this all gets back to how did we get to where we are today? So as the Fed has ramped up and frozen, by our estimates, around 40% of potential buyers out of the market, we saw housing starts really tumble starting in around March of last year. But what's really interesting, those well-known supply chain snarls, they have resulted in build times being quite elongated. So the time to build a home. And so as a consequence, we have really elevated numbers of housing units that are under construction right now, both on the single family side as well as on the multifamily side. And this tracks quite nicely right now where we're seeing demand for building materials and building products. So those products that go in on the front end, closer to the start of the home, those more commodity type materials, such as lumber, engineered wood products, demand has really dropped off for those. But if we look at where there's strength on the new construction side, it's all those products that are going in closer towards completion. For example, windows and doors, cabinets, insulation. So I think that's part of the reason why there's so much volatility out there, is because there's a really interesting backdrop in terms of starts just contracting, reacting to interest rates, but then build times remaining extended. There's a real concentration of what products are in demand. And those are more of those that are on the end of the construction process. When you just look at when a home is construction, all from foundationing and framing all the way to interior finishes and the final steps. It's really those interior finishes and final steps. That's where the demand is right now. The other component to that is remodeling, which has historically is less interest rate sensitive, We see a lot of strength, particularly in those replacement type projects. If we look at the drivers of where there's likely to continue to be building material inflation, it's more of those, I would say, those finished type products that have higher model exposure. So, for example, kitchen and bath insulation, decking and railing, those are the ones where prices are more likely to hold up. Going back to how starts have really dropped off, those ones that are more commodity type, lumber being one of them, has a higher new construction exposure. That's where there's likely to be more deflation. So pricing really correlates quite well to where there's demand right now. And that goes back to this just really interesting backdrop that led us into 2023.
Yeah. Well said. Tell me about this. As I'm looking at, if we just kind of isolated, call dimensional lumber, we're talking panels, we're talking EWP, based on what's been happening and it's pure anecdotal. So tell me if you're like, Hartman, good theory. I think you're going to be wrong. And I'm totally fine with that. But my kind of prediction is this, for a long time, last several decades, right? Those products, EWP, panels, dimensional, has been really consistent. And then we've seen a lot of volatility and then kind of slow buildup, or in some cases, not slow buildup at all, but a buildup. And then kind of something happens. And maybe it's seasonal, maybe it's driven by kind of demand among the big builders, but we see kind of a sharp drop off. And then we kind of see it start up again. I'm kind of visioning the future is going to be, specifically on those kind of structural products, if you will, or front end products, is going to be more of kind of a sawtooth shape as opposed to kind of more of a sine wave where it goes kind of up and down. As I say that, I have zero of the training you do. This is pure speculation, but I'm willing to kind of make a prediction. This is what I think it's going to be. And if it doesn't, if it's stable, hey, fantastic. I think humans in general operate really well in stable environments, but when it's volatile, we have a lot of the fear and then we go back and forth between the fear and the greed. What do you think about that? Is that possible that we're going to see on those products more of a sawtooth trajectory here in the coming years?
I think you're dead on, Bradley. And we've looked into this in our research, and we found that overall building materials demand has just become way more volatile. And that's because of the inputs that go into those demand drivers. Cycle times, the time to complete a home, a lot of volatility in there based on the supply chain. If we look at prices, building material prices, there's a lot of volatility in there based on the inputs that go into different building materials. If we look at starts, a lot of volatility in there as well. So if you put all these together, we're in a situation where we have much more volatility and demand, which translates into more volatile prices. I also think a lot of those supply chain issues that have really loosened quite a bit as economy has decelerated haven't really been solved. So given how interest rate sensitive the housing is, when the Fed does bring down rates and there's another surge in demand, likely going to collide with those supply chain constraints again, leading to more volatility. So I think volatility is here to stay. It's a theme that we've been emphasizing in our research. And I think you're dead on that view of what we can expect in those materials.
Got it. Well, I hope for both of us, for all of us, I'm wrong. And it just goes back to being nice and stable. And we say, hey, we got through the worst of it. We got another 5 decades of stability in terms of those commodity prices, but I don't want to bank on it. So maybe give us your projection. And I know obviously the Fed is kind of forecasting to some degree, but if we agree that obviously interest rates obviously is the big rock being dropped into the pond and the ripples out from there. And if we are going to see another kind of surge that's going to impact everything from supply chains, just our daily life and frustration of trying to build America here, what's your expectation here? Maybe take me, and again, I don't know if you can do this. No one's going to invest on this insight, but fast forward 6 months here. We're meeting here in August, September there. What do you think? Do you think that interest rates at that point are going to be kind of sitting where they are now? They're going to back off a little bit? If we do see, the economy just totally slam on the brakes, will the Fed start knocking off half points at a time on the interest rates? I don't know. What are your thoughts at that point?
I think markets are expecting a couple more Fed rate hikes, probably 25 basis points each.
Okay.
But this is really there's such mixed signals within the economy right now. As you mentioned, the labor market is really strong, really resilient. And then we also had a recent inflation reading where inflation is still elevated. So the Fed's going to continue to want to rein in inflation. So my expectation is we're going to have weak economic growth this year. Whether we have a recession or not might just be semantics.
Okay.
But once we get through this period, this reset period, then we'll have stronger growth, particularly when we think about building materials on the remodeling side. New construction, I think, is going to have a little bit more of an adjustment period. Affordability needs to be reset. Builders right now are using incentives to a large extent to really solve that affordability issue, such as rate buydowns. So, I do think that we are looking out much longer term. We are going to have strong building materials demand. We still have a shortage of homes, structural shortage of homes. Our chief demographer, Chris Porter, has done a lot of great work on this, and he estimates that over the 2020s, we're going to need around 17.1 million new homes. There's an interesting dynamic that's happening here in terms of going back to, there was a ton of refis that happened. Homeowners took off those funds and remodeled. And also when they purchased homes, they secured very low mortgage rates. So because of this, a lot of households, we estimate around 87%, are locked in place with mortgage rates below 5%. This means that they're going to stay in their homes longer and likely remodel rather than move. But this is also an opportunity, given there's just zilch existing home supply out there, for builders to come in and fill that supply void. I think longer term, we are positioned quite well. More softness on the new construction side, building materials that are going into that segment. Stronger growth on the remodeling side, that lock-in effect that I mentioned, as well as record high home equity levels. We estimate the average homeowner has around $350K of home equity, which is, once rates come down, draw from that equity and support longer term remodeling.
All right. As we wrap up here, I feel forced to share some unsolicited advice. I've just seen so many headlines, and I'm talking to clients who are kind of reading some of these headlines. They're saying, I don't know, man, did you see that? We're 70% off from the pricing or from the levels or fill in the blank from where we were just 18 months ago. And while true, I will also say is, I don't know, this probably happened to you. It's happened to a lot of our listeners, where someone said, do you know this house across the street? Do you know what it just sold for? Therefore, do you know what our house is worth? And I thought, it's magic money. This is fake money. No, it's not. Unless we want to sell and then buy a more expensive house. I feel like we have collectively a short-term memory of what happened. And yes, we might be 70% off from where we were 18 months ago. 18 months ago was fairyland. It was Bananaville. It was nowhere close to reality. And now we're somewhere back to it. So, and that's where I've been saying, are we in a recession or not? I don't know. I don't care. Talk to your customers, talk to your suppliers, talk to the smart people around you, talk to economists who know your local market, and make those decisions instead of just reading these headlines that, again, headlines are used to get people to buy papers or to read this stuff. So that's kind of my unsolicited advice of just, hey, do your own thinking, take a step back, talk to the smart people there locally. Maybe to wrap us up here, maybe one piece of advice that you have that we haven't covered, or maybe reinforce what you have shared as we wrap this up.
I think, and it's something that we spoke about in San Diego, that diversification is really key in these over economic cycles. So one, for example, we've spoken about different building materials and building products that are better positioned right now. We've spoken about remodeling relative to new construction. I like to just jog my mind. The Nobel Prize winning economist Harry Markowitz once said that diversification is the only real free lunch. So when you think about this, and we've done the math on this as well, going from, say, 100% remodeling focused portfolio to one of, say, a 70-30 split of remodeling and new construction, actually, you can increase returns without incurring additional risk. And I think this, you can make just because there's very distinct drivers in remodeling and new construction. And similarly, if you get into the building products as well, and building materials, there's that same point here. So I think one thing is that having diversification over economic cycles is really key to weathering these storms and maintaining cash flow. And I think for a lot of these businesses, cash is king. And so having that diversification is really important. You don't want to be only tied to lumber and engineered when starts have dropped off. Then you're in a really difficult place. You want to have exposure to products that have broader end market exposure within the construction process as well, to be able to diversify over these economic cycles. So that's my piece of advice I give.
I love that. And I think for many of our listeners, This is something they're doing in their personal lives. It's called modern portfolio theory. Diversification, protect yourself. How old are you? How long are you going to live? Stocks versus bonds. Like, how do we balance this so we can continue the growth on average 8% year over year? And we've got two different clients of ours where we kind of started this between both of them about a year ago. And we kind of said, here's the new mandate that it's going to be X percent. Maybe it's for one, it's like 10. The other one's closer to 20. 20% of annual revenue every single year is our goal. Starting now is going to come from remodeling, good times and bad. So how can you start balancing that a little bit? But again, it starts with measuring what you've got, making some goals. Yeah, you're going to have to structure your roster a little bit. A sales guy and an operations team who services remodelers is very different than someone servicing your KB Homes or your Lennar, your MI, right? So I love that. And I will say, I'm fairly confident you are going to be the only one who recalls a memorable anecdote from Nobel Prize winning economist Harry Markowitz this week. So point for you on that.
Sorry, I like to geek out sometimes, Bradley, so I apologize.
I know. I love it. All right, man. Hey, love having you on the show. If you are willing, what we'd like to do is have you back here when we have these moments here, having somebody with such expertise, obviously you, as well as John Burns Real Estate and all the folks that you have on your team, from demography to statistics to obviously the economy and everything else, coming in and giving us a little insight here is extremely valuable. So thanks again.
Anytime. It's great to see you, Bradley.
All right, friends, how did that go? Hopefully you enjoyed my conversation with Matt Saunders. Every time I talk to him, I feel like I can breathe a little bit easier as I can understand some of the conflicting data that comes out every single day as to what's happening in our construction industry and what's happening in our local market. So hopefully you enjoyed that. Our goal is to have Matt come back frequently to the show to give us these insights as to what they are seeing as John Burns Real Estate Consulting is the best in the business. If you did enjoy this episode with Matt Saunders, please rate and review the podcast. Those mean more to us than you know. Also, we host the video of these conversations on YouTube. So if you're not subscribed there, let me tell you, you're totally missing out. All the cool kids are going to YouTube, subscribing to our videos that we're putting out there. And of course, they're 100% free. So if you do hear insights, when you do hear insights and you want to share them with your team or your customers or your prospects or anyone in your network to share these insights broadly, you can go simply do that, obviously, through the podcast. You can share that. That's free. Or you can send over these video clips that we are curating for you to make it easier to share insights. That's what we're trying to do here. The giving never ends at the Construction Leadership Podcast. All right, friends, this episode is brought to you by the Simple Sales Pipeline. It's the fastest way to organize and quantify your sales forecast in the future so you're not flying blind into the inevitably uncertain future. The future's always uncertain. So check out thesimplesalespipeline.com. That's all I've got. I'm going to get the hell out of here. As always, thank you for listening. You, my friend, are owed nothing. Deliver value first.